I am very bullish, particularly on the commercial real estate side as well, because it has totally bottomed out. The recovery has started, and as we speak, I mean, leasing. If it would take 6 months to lease a property, today we are finding that we are able to do it in 2-3 months because the supply of grade A assets is not there, whereas the demand is growing. So, last year itself we had an absorption of 34 million. This year they say it will be 40 million. So I'm saying there is, I personally think that it's a very, very important time for investors to get into the real estate sector and make money for themselves. Strategies which were focused on pre-leased core and core plus assets, it was a moderate risk and a moderate return kind of investment strategy that we had, because the only risk that you were taking was a leasing risk. Sure. No, I think there is definitely traction, from the ultra HNIs, from family offices, corporate houses, and even insurance companies. I mean, we have one of the biggest insurance companies of the country who's participated in our fund, which means that despite slowdown and despite the fact that there is oversupply and despite the fact that demand is yet to pick up, people know that, so you see, whenever an investment is made, it has to be made with the exit in mind. And if the overall indicator suggests that demand is going to pick up and absorption is going to happen, obviously it's a good thing to do, because 3-4 years down the line, when you need to exit from the fund, there will be many takers. While anyone makes an investment in a fund house, because we are all close-ended funds, it's very important that we have to keep the exit in mind. And I think HNIs do understand the importance of that, because HNIs are showing a lot of interest, with rental yields northbound 9 to 10% and capital appreciation because of the yield compression which will happen. I think it makes a overall very, very good sense for an investor to lock in his money at a 16 to 18% kind of a return on a commercial pre-leased core product. So there are, fund houses will keep coming up with various products. I think what is important for an investor is to go with the fund house who's got a track record of taking and giving back money. I think that is very important.
Basically a debt cum equity product, I mean, so to say. So debt, of course, from the rental yields that the property, generates, and equity when, because of the capital appreciation and a falling interest rate regime, we expect that there will be good equity returns also to be earned on every single asset that we invest in.
Okay, also tell us then, what are the kind of assets that you're looking at and what geographies you're going to look at?
We have identified, projects in Hyderabad, in NCR, in Mumbai, in Bangalore, and in Pune, where the fund monies will be invested in. Idea is that we should not only find the right property in the right location, but also where there is a good and healthy tenant mix.
You're also looking at exiting out of REITs, I believe, and you've also identified assets for commercial assets in all of the geographies that you just spoke about. If you could just tell us what your exit strategy would be.
Of course, investors will get an opportunity to exit through REIT listings in the coming years.
Also, with the new norms that have come in from SEBI recently, do you think there's a lot of money inflow, there's a lot of interest for REITs right now?
What I think and what is holding people back as far as REITs is concerned is the that the commercial valuations of assets is still pretty depressed, and nobody would like to go in for a REIT listing with these kind of valuations. So I think given 18, 19, I think those are the years when the valuations would of course go up, because in most of the select micro markets, demand is more than the new completions which are taking place. And as demand supply mismatch sort of narrows down, the valuations will obviously kick in. So the rentals have started going up, vacancies have started coming down, and when the valuations reach a proper stage is when people will actually benefit from REIT listings.
We are looking that commercial market is really looking upbeat, because the prices have been subdued for a very long time now. In fact, the vacancies also in the market are running at their 10-year lows, and the demand in the market has also reached its peak high. So to say that the demand is higher than what it was in 2007-2008. So today, current demand in commercial real estate across Indian cities is somewhere in the range of about 43 million square feet, which used to be about 37-38 million square feet at its peak time. So we feel any sort of investment in an asset class, probably commercial real estate investment, is looking very, very attractive. Not only are investors entering at a higher yield in this asset class, but at the same time, there is a certainty that the prices would be rising, because you are entering at a market at almost its lowest end. We feel probably the market is right for entering again into this asset class, because next 4 to 5 years are looking very, very rosy and very, very bullish. In terms of returns delivery to investors, returns would come to investors in two counts. One would be the quarterly payouts that the investors would be getting, which would be quarter on quarter, the rentals that we would be drawing from the properties where we would be investing, we would be giving back to investors in the form of quarterly payouts. And an investor over a hold of about 5 years could expect somewhere in the range of about 45-50% of money coming in the form of quarterly payouts. And then capital gains, which would be when we would be liquidating these properties. Now, another interesting thing that we have introduced in this fund is that we are trying to do a REIT listing in about 3 to 3.5 years from now. So that would ensure that long-term capital gains tax, which is applicable in SEBI registered funds, might not be applicable, because the hold of the investor would be more than 3 years, and then it would be treated more like an equity. So that again would add up to about 150 to 200 basis points additional return in the hands of investors on a post-tax basis.